Most agents think of financing and the appraisal as two separate conversations. They're not. How a transaction is financed determines how exposed your buyer is if the appraisal comes in short. And it determines how the seller reads your offer before they've even accepted it. The agents who understand that connection win more offers and have fewer late-stage surprises. Here's the scenario that plays out constantly in competitive markets. Two offers on the same property. Offer one is at asking price with a conventional loan and a standard appraisal contingency. Offer two is also at asking price but with a fully underwritten approval, large down payment, and a buyer has already signed an appraisal gap addendum committing to cover up to a certain amount above the appraised value. The seller's agent knows something that the first buyer's agent may not have communicated. Offer two has a stronger financing foundation and carries less risk of falling apart if the appraisal doesn't come in exactly at value. Which offer do sellers accept when price is equal? Almost always the one that feels more certain to get to the finish line. And financing strength is one of the clearest signals of certainty. Here's how financing strength actually changes the appraisal conversation in three specific ways. First, down payment is an appraisal buffer. A buyer putting 20% down on a $600,000 home has a $120,000 down payment. If the appraisal comes in at $590,000, $10,000 short, they can absorb that gap with their existing down payment and still hit the loan-to-value ratio if needed without any renegotiation. A buyer putting 5% down doesn't necessarily have that flexibility. Their loan is priced based on a specific loan-to-value, and an appraisal gap creates an immediate problem. This is something agents can communicate to the seller's agent before the offer is even accepted, and it changes how the seller perceives the risk profile of the transaction. Second, the fully underwritten approval versus the standard pre-approval. A pre-approval is a conditional review based on what the lender has seen so far. A fully underwritten approval, where income, assets, and employment have been verified and underwriting has already reviewed the file, is significantly stronger. The only remaining condition is the property itself, the appraisal, title work, home insurance. Sellers and their agents know the difference. Third is the appraisal gap addendum. In competitive markets, buyers who are willing to commit in writing to covering a certain amount of the appraised value shortfall, say up to $15,000 above the appraised value, make their offer materially more attractive to a seller. This is not something every buyer can do, but for buyers who have the reserves, it's a meaningful differentiator. Three tools, all of them financing decisions, not offer price decisions. And all of them are conversations agents can have with their buyers before the offer is written, not after the appraisal comes back short. An agent I worked with had a buyer who lost 3 consecutive offers. Similar story each time. Offer came in at or near asking, financing was solid on paper, and the deal went to someone else. The agent called me after the third one, and when we looked at what the winning offer had in common, larger down payments and in 2 out of 3 cases, fully underwritten approvals rather than standard pre-approvals. We restructured the buyer's approach. She already had a strong income and significant savings. She'd just never been told to position the down payment as an appraisal buffer. We got her a full underwrite before she wrote her next offer, and we prepared an appraisal gap addendum for up to $12,000. Her next offer, at the same price as the previous 3 that lost, was accepted. Same buyer, same market, same purchase price, different financing presentation. The good news is the property appraised at value, so the gap addendum was never triggered. But the seller chose her offer in part because it was structured to handle an appraisal variance if one occurred. Treating the financing conversation as something that happens after the offer strategy is set. Agents who work with me closely bring me into the buyer consultation, the first meeting before any properties are identified. We talk about what the buyer's true financing position is, what levers they have in a competitive situation, and how to structure the financing in a way that makes their offer as strong as possible. Agents who call me after a buyer loses their third offer aren't having the right conversation, just 3 offers too late. One concrete thing to do with a buyer before they write their first offer, ask them 3 questions. How much do you put down, and is there any flexibility to increase that number if the right property comes along? Have you been fully underwritten or just pre-approved? Number 3, and if an appraisal came in $10,000 to $15,000 short, is that something you could absorb? The answer to those 3 questions tell you exactly what your buyer's competitive toolkit looks like before you ever get into a multiple offer situation. Bring me into that conversation because I will help you translate the answers into an offer structure that actually works. You can schedule a call with me at teamaronheim.com for realtors or just text me at 303-596-9077. The agents who work with me closely are the ones who think about financing as a competitive tool, not just a qualification requirement. If that's how you approach your buyer, we should be talking. Schedule a call at teamaronheim.com or just text me at 303-596-9077.